If you've bought a stock that felt like a sure thing, only to sell it at a loss weeks later, the problem wasn't the company. Investors often lose money because they pick a strategy that actively fights their own psychological limits. Take growth investing. This strategy targets companies, usually aggressive innovators in the tech sector, that are expected to expand their revenues far faster than the rest of the market. These companies operate with a specific mechanic. Instead of paying out cash to their shareholders today, they plow every cent of profit right back into the business, trying to dominate emerging industries. But that ambition comes with a heavy psychological cost. If a growth company misses its revenue targets even slightly, the market panics and the stock price drops drastically. You have to be emotionally equipped to watch your portfolio value drop 30 or 40% without blinking. In this exchange, you sacrifice current financial stability for the chance at explosive, unpredictable gains years down the line. The opposite approach is value investing. Instead of chasing future potential, value investors look for established, profitable companies that are currently trading below their estimated worth. This method relies on seeking quality companies at fair prices. The philosophy was developed decades ago by investors like Benjamin Graham, who realized you could build wealth by finding current, reliable bargains. Graham's student, Warren Buffett, proved the success of this strategy by steadily acquiring stakes in unglamorous, highly profitable businesses over decades. To quickly identify which strategy you are looking at, investors use a metric called the PE, or price-to-earnings ratio. This side-by-side comparison shows growth stocks typically carry a high PE ratio, while value stocks carry a low PE ratio. A high number on the left means buyers are willing to pay an expensive premium right now for the promise of future profits. A low number on the right means you are paying a discounted price for cash the company is already making. Checking that metric clarifies the trade-off. You are deciding whether you want to pay a high cost for a high ceiling or a low cost for a reliable, solid floor. This quadrant chart plots volatility on the vertical axis and the reward mechanism along the horizontal. Growth stocks sit in the top right. The risk is elevated, with potential for massive upside. Value stocks land in the bottom left, offering reliable dividend income. Both paths demand a specific emotional discipline. Growth investors have to survive market crashes without selling in a panic. Value investors have to endure holding steady, while others appear to get rich quickly on the latest tech trend. The choice between these two frameworks depends on individual psychological wiring rather than any objective ranking of the stocks themselves. Individual companies don't operate independently of the broader economy. A massive macroeconomic force dictates whether growth or value is currently winning across the entire market, and that force is interest rates. Because growth stocks are priced based on profits expected years from now, rising interest rates act like gravity on those valuations. When it becomes expensive to borrow money, those distant profits become less valuable today. During high-rate periods, value stocks become appealing. Investors want safety, and these companies offer immediate, tangible cash flow that doesn't depend on cheap debt. The reverse is also true. The near-zero interest rates of the 2010s made borrowing practically free, which fueled a decade-long growth boom for tech companies. Markets move in cycles. When beginner investors don't understand how interest rates shift market leadership, they often abandon successful strategies the moment the economic weather changes. Knowing the theory doesn't protect you from the traps in execution. When the assumptions behind these strategies fail, the financial damage is swift. This matrix highlights the hype bubble for growth investors. High expectations driven by social media, but terrible fundamentals. Conversely, value investors face the value trap, a seemingly cheap stock where the underlying business is actually collapsing. Both hype chasing and value traps lead to the same outcome: severe loss caused by mistaking a stock's price tag for its actual worth. Choosing the right path for your money requires an honest look at your personal profile. This flowchart maps out the decision, starting with your time horizon. If you are a young investor with 15 or more years to retirement and you can stomach a severe market drop without selling, you may decide to heavily weight your portfolio with growth stocks. You trade short-term peace of mind for maximum long-term upside. However, if you are nearing retirement, or you know you will sell everything during a sharp market drawdown, you lean toward value stocks. You accept slower overall growth for capital preservation and a reliable stream of dividend income. Your age and your emotional resilience are far superior predictors of wealth than your ability to guess the next hot stock. Many institutional investors reject the tribalism between these two camps and choose to do both. A blended portfolio balances out the extremes by pairing fast-growing tech innovators with stable, cash-generating dividend payers. Diversifying means you forfeit the chance to own only the single best-performing stock, but you eliminate the risk of a catastrophic portfolio failure. The boundary between growth and value is fluid. Even legendary value investors eventually buy major tech companies once those businesses mature and their cash flows stabilize. Building long-term wealth requires the discipline to match specific financial tools to your current stage of life and maintaining that consistency over decades.